Right. Question one, all the following accounts would allow parties with access to the account to withdraw, except, let me shrink that down so you can see all your answer choices. There we go.
Between B and D.
And that's what we want to do. We want to talk it through so we can see.
Yeah, I'll get it down to 2 and then we can, I usually try to do that. I don't know what tenants in common, what a TIC is, but D doesn't make sense. Like a limited power of attorney. I don't think you would be able to withdraw from your.
You are correct. That's what limited means. Limited means all I can do is make investment decisions for you.
Yeah.
Okay. So that's referred to as limited power of attorney, limited trading authorization, full trading authorization, full power of attorney. I can withdraw monies and securities. Okay. Tenants in common is where there's more than one party of the account. They have fractional interest, 80-20, 70-30. And then the major testable point is the distinctions between B and C when somebody dies. Tenants in common, that goes to their state or beneficiary, their proportion ownership. Joint tenants with rights or survivorship, it goes to the surviving party. So B and C, the differences between those at death is very testable.
So C is, you said joint tenants, it goes to the surviving party?
That's right. So usually it doesn't have to be husband and wife, but it usually would be husband and wife. Husband dies, goes to the wife. Wife dies, it goes to the husband. And either party can act, and the account is not frozen. Tenants in common, if it's like 70-30, doesn't matter, 80-20, 50-50, the decedent share goes to their estate or beneficiary, and the account is frozen.
Oh, okay.
FINRA and the other self-regulatory organizations place extreme importance on knowing your customer. This involves knowing both financial and non-financial considerations. All of the following are non-financial considerations, except.
Is it B, the number of children a client has?
Well, remember, it would be something that is a number that could go on a balance sheet or an income statement. A balance sheet or an income statement. So the number of children you have is important, but it doesn't go on a balance sheet or an income statement.
I would think A, the salary paid.
There you go, right? That's the financial consideration, right? I say, Allison, for me to do a really good job for you over time, need to know a lot about you. I'd like to do a balance sheet, and then I'd like a picture in time of where you're at right now, and then an income statement. See how much money we got coming in, how much money is going out. See if we can find some opportunities to redeploy some capital. Again, your point, I don't say I'm not interested in your children or your attitudes toward risk. Those are very important. Or your age, they're just not a financial consideration. Which of the following best describes the size of a quote?
Oh, this one's going to be hard. It tells the number of shares that went. It tells the number. Between A and C?
You're correct. You got a 50-50.
Yeah. It doesn't number shares are traded. I think it's C.
You are correct, right? If I'm a market maker and you ask me my quote, I say 15, 16, 8 by 8. That means I'm willing to buy 800 shares into my inventory at my bid. That's the buy. And I'm willing to sell 800 shares out of my inventory at the ask. And, as a market maker, I buy at the bid, I sell the ask. That's called my spread. That's called my spread. And if I fail to honor that test question, so, you say, Dean, what's your quote? 15, 16, 8 by 8. And you say, I'm buying 800 shares. I say, I changed my mind. Very testable. If a market maker fails to honor a firm quote, that is a prohibited practice and is known as?
It's not forward pricing. It's
backing away. Backing away. Very testable. They'll say a market maker fails to honor a firm quote. This is a prohibited practice and is known as, and you say backing away.
To make a quote. Okay. Customer owns 1,000 shares of stock subject to a reverse stock split. Position will now consist of, okay, so a reverse stock split is less, I know this is going to sound stupid, less pizza slices.
That's exactly right. That's the whole point of it. The whole point of it, it's bad news. I mean, we're trying to get our stock price up through a marketing gimmick rather than through building the business. You know,
I like this website better than Notman.
Oh, do you?
Well, I really do. Yeah.
Oh, okay. Okay. Well, that's
these are more like the actual exam.
Well, yeah, it's different layout is what it is. Yeah. So anyways, you're on the right track, right? So 2 for 3 reverse. Yeah. So that means for every 3 shares, you now have 2 shares.
Yeah. So it's fewer shares. So it's between B and C. Fewer shares worth more per share. Is it B? Worth more per share?
What is you? I'm sorry, your choice is B.
It's between B and C because it's fewer shares.
Oh, yeah, you're correct. So which one are you picking?
Fewer shares worth more per share with the same net. Fewer shares worth less per share with a decreased net. Ooh. No, it's B.
Right on. Good job, right? Yeah. There's no change in your position as a result of a split. If it's a forward split, you have more shares at a lower price, but the same value. And if it's a reverse split, you have fewer shares and again at the same value. So it's a way of getting the stock price up.
Worth more, yeah.
All the following regarding the firm element of a broker-dealer's continuing education are true, except.
All the following regarding, oh yeah, it is. Between D.
You're correct, D or
C, just because it's worded, it compromises training. I don't really even know what that means. For those who have direct contact with the public, comprise it? No. I think it's D because I don't think it's prepared. Ours is
come on. Fender doesn't do anything for us, right?
No, my firm, we just created ourselves, right? And then you said,
and it's got to be germane to the firm, right? So, you just can't buy something from a consultant or vending firm that doesn't, match up with the business you're doing. At your firm, that would be kind of challenging because you're, a different broker dealer than most.
Exactly.
Your customer buys 300 shares of Tools common stock on Tuesday. And will be an owner of record as of the close of the business that same Tuesday. Wow.
So it's T plus 1.
Well, yeah, but it said it's on the same day. So
it must be a cash, right?
There you go. Cash settlement, right? So
cash is same day, right?
Cash is same day. So, I always joke there are irregular ways to settle trades. We assume everybody's doing business the regular way. But there are
mutual fund.
Mutual funds don't have a settlement. No, it's just when they do the next calculation.
Okay, because it's there's an F.
Yeah, because you're doing the business directly with the fund, so it doesn't matter.
That makes sense.
Trade date is when we agree to terms. Settlement is when ownership changes hands. So
yeah, okay, that makes sense.
A debt-based unit investment trust will feature which of the following?
Is a UIT. A UIT is passively managed.
That's right. Well,
no, it is.
Go on. Yeah. But, just.
What is it? Managed by a portfolio of bonds. A fixed portfolio of corporate bond mutual funds. I'm between A and B because it's not C.
It's not C, and
it's not D.
Yeah, and it's kind of, this one's tough.
It's kind of a passively managed portfolio of bonds, a fixed. I thought it's passively managed and fixed, but I could be wrong.
Yeah,
is it so mutual funds? Maybe it's B. I don't know.
No, I'm gonna mark it wrong just because we're trying to get a mark.
Yeah.
But it's a fixed portfolio bond. You were on the right track. And so passively means that they're professionally selecting the assets initially, but then after that, they're not managed. They're professionally selected, but not managed. So I thought this one was kind of tough. It's actually a fixed portfolio bonds that have been professionally selected. Low probability. It's D. It's D.
Oh.
Only because D is a better answer than A, because passively managed means they're still doing something and they're not. So it's the answer set, I think, that is problematic here. In fact, when I teach this, I usually lecture and say it's a passively managed fixed portfolio, but so that could be a challenge.
Oh, okay. So I should just look out for, but
yeah, I think it's a low probability. If you tell me you missed your mark because of a UIT, I'm going to say I don't think so. But it's a fixed portfolio.
Fixed portfolio of bonds, but
that's right. Well, it doesn't have to be bonds; it could be any fixed portfolio.
Oh, it could be anything.
Stocks.
Okay.
That's right. Which of the following accounts would allow the assets of a single father's account to go directly to his daughter while voting probate, but not let her access while he's alive? This is very much a test question.
So D, joint tenants with rights of, that's going straight to the surviving party. So it wouldn't be, but would not go.
Well, remember though,
oh, okay. So it would be, would allow assets to go directly to his door while avoiding, but would not allow while he's alive. Would it be D?
Excuse me?
Would it be D, the joint?
No, it's transfer on death. Remember the key point here, it says not let her have access while she's alive.
Okay.
If that was joint tenants with rights of survivorship, she would have access to the account.
So would he say?
Yeah, so it's transfer on death. So, if we have transfer on death, I put whoever this is. When I die, they get it and it avoids probate. So very much a test question. Here the one on the test will usually, it's like an aunt who has a nephew, and they give you some story like the nephew is not up to the task of getting the money now, and how can she make sure he gets the money without probate and avoid his creditors until that time, so something like that.
Okay.
All the following statements are true except. All the following statements are true except.
Ooh, this one's tough. Well, C is true. Or do they do common stock? I'm gonna go with I'm gonna go with A.
Excellent. Excellent, right? Because open-end mutual funds can only have one class of equity, common stock. They can buy bonds, but they can't issue bonds. They can buy preferred stock, but they can't issue preferred stock.
So mutual funds
excuse me. We missed this because it says all the following statements are true except, and A is true, D is not.
Okay. No, that's okay.
Right. By the way, we should have had a 50-50 on that, right? So
sorry. I was
closed-end funds can. Yeah, closed-end funds can, and open funds cannot.
So closed.
Yeah, you're going to get tested. Not just that one. You're going to get tested on the difference between open-end and closed-end. The major difference is open ends are continually offering new shares, closed end trade supply and demand, but this is another distinction between the two.
Okay. I wish I might, yeah.
Minimum maintenance on a long margin account is?
Is it 30 or 25?
Excellent. It's excellent. 25 is for one and 30 is for the other type of
account. I know. I think 25 is for short. No, I think 30 is for short, 25 is for long.
You're correct. Good job.
Yeah.
And then the 50% is to get going initially.
Yeah. Yeah.
Right on. Good job.
Mhm.
Good job. Which of the following are called systematic risk? Systemic risk, those that would impact all businesses. All businesses.
Definitely inflation.
Yeah, that's exactly right. Right.
So that's how I typically do these. Like I'll pick one.
Yeah,
And
I
then,
think you're right. You need
okay, so
inflation risk, so
B,
you need two. That's
yeah,
definitely way to
A
go.
and B are out.
Right.
Then I go to market risk again is this is where 1 and 2 or 2 and 3 regulatory risk. Regulatory risk is what, like that they change regulation.
Yeah. Yeah.
Ooh. I'm gonna go with D, 2 and 3.
Regulatory risk can be avoided by not being in a business subject to it.
Oh,
Right.
yes. So
So
is it market? It's market
yeah,
risk.
it's market risk and inflation risk, right? So
Market risk is
the tendency of securities prices to move together.
yeah.
I think it's almost easier to think about what is non-systematic risk. Non-systematic risks are risks that you can diversify to mitigate. For example, non-systematic risks like selection risk, picking the wrong thing. The easiest way to do that is to diversify to avoid that, right? 10 equally suitable ideas. You bought one of the 10, the other 9 did fine. The one you bought went under. And so the way to avoid that is through diversification. Now, things that can't be diversified, risk prevails despite your diversification is systematic risk. I don't care what stock you have. The market goes down 20% tomorrow. Your stock's probably going down as well. And so the risk prevails despite diversification. So you were on the right track with the inflation risk. And the market risk is also systematic risk.
Went too quick. That happens to me too.
The X date by a mutual fund is set by whom? So the X date is the first date on which a stock or a mutual fund, in this case a mutual fund, no longer trades with the dividend.
Isn't it the exchange where the trade takes place?
If this was a secondary market, it would be the Uniform Practice Code. But you're doing business directly with the mutual fund. There is no secondary trading, so it's all set by the board of directors. The board of directors of the Vanguard Fund are going to say, we're declaring a dividend. It's payable shareholders of record at the X is the day after the record date in a mutual fund, and then the payable date. All of those dates are set by the board of directors.
Yeah, mutual fund. There's no
There's no secondary trading.
I need to do some reading on that.
That's no worries. Regarding well, that's what we're doing, right? We're just doing an intellectual inventory to see where you're at here in terms of our timeline for getting this done. Regarding a tombstone advertisement, all the following are accurate statements except a tombstone.
I'm between B and C.
You are correct. It's either B or C.
Yeah. Required by and file. I think it's the only. I think, is it C?
Good job. Excellent. All right. Well, you can choose to have a tombstone or not. It has nothing to do with the SEC. An investor in a direct participation program wishes to divest of a partnership interest purchased some time ago. You could correctly advise that.
So DPP, which
Yep.
is
Partnerships.
Okay.
Direct participation program.
There is ample secondary market trading. Do they trade in the secondary market is the question. DPP. I look at a DPP as like a business.
It's a partnership, right? So if I buy a partnership in this, for example, I invest in a Blackstone fund.
Yeah, exactly.
Right? So before I invest in a Blackstone fund, what should you tell me?
I don't think there's no secondary market.
Right on. Boom,
Yeah,
right?
so it's J.
Yeah, so you shouldn't invest in these kind of transactions unless you're going to make the hold, right? Whatever the hold may be, right?
Yeah, it could be 7 years, 8 years.
Well, yeah, whatever the target is. A customer purchases 100 shares of Bob common stock for a total of 3,000. After 1 year, they sell the position for 3,200. Bob paid $1 per share in dividends. What is the total return? What is the total return?
So he made 200.
Right on. Good job. You're off to a great start.
Paid $1 per share in dividends over the year. What's the total return? So I'm going to be honest. I don't know how to do this.
Okay, so you're on the right track. Okay,
yeah,
well, you want to do your guess first?
It's A.
You are guessing incorrectly.
Okay. And so maybe how would you do this
Yeah,
one?
yeah. So there's only two ways. There's only two ways to make money in an investment. The two ways you can make money is from the income stream and or price appreciation. Okay. So when we're talking about total return, we're talking about what did you make from the income from the investment or price appreciation. And remember that number could have been negative. So we have price appreciation, plus we have the income we receive from the investment. And so now we're going to take that number. So I thought you were on the right track here because you correctly said, well, I made $2 from the stock. That's correct. And so let's put that there. And you made a dollar in dividends. So let's put that there. And so you made a total of $3, total return. You made a total of $3. Now, to make that $3, you put up $3,000 originally. So we take your $3 that you made and we divide by the $3,000 you spent to make that.
That's 10%? Yeah.
Yep. Right.
Okay.
So those are the ways you make money. You make money through price appreciation or income. I always joke, like if you buy raw land, there is no income stream. The only way you're going to make money
is if you
sell it to someone else for more than you originally paid for, right?
Price appreciation, income. Okay.
Yeah. And again, so same in a stock, right? If you buy a stock with no dividend, the only way you're going to make money in that stock is through price appreciation. Yukon Gold has secured rights to develop a rich vein of precious metals in a foreign country. Short after the facility begins production, the government of that nation collapses, and the new government's insisting on renegotiating the contract with the company. This is an example of
this is political risk.
Yeah, right on, right?
I don't do well with these though.
Yeah, well, regulatory risk, that wasn't regulatory risk because regulatory risk would be U.S. Legislative risk would be Congress. And business risk, that's a little extraordinary. It's not like business risk like you as a management team screwed it up, right? It's that some dictator came and took your stuff, right? So, when you invest outside the U.S., you have greater reward potential, but that's because you're taking greater risk, right? I mean, I have a friend, he was working in Russia, and he had come back and to the U.S. He was telling me how much more money he made in Russia, but his boss was the first American shot by the Russian mob. He went to the subway and also his bodyguards disappeared, and what had happened is the Russians wanted to buy him out of his Hotel Renaissance, and they were pretty clear with him that, yeah, he said, no, I don't want to accept that. He's from Madison, Wisconsin. His name was Paul Tatum. And he said he thinks he's in the US and that, you can say no. Anyways, when he came back, my friend David, I said, yeah, you made a lot more money, but they shot your boss. And he goes, well, there's a lot of violence here. I go, but yeah, it's usually not over business dealings. I mean, is there a lot of indiscriminate violence? But it's usually not because I didn't want to sell you my interest in a hotel that somebody's going to shoot me.
100%.
The following strategies, which is considered most risky in a strong bull market. So a strong bull market, I always say, don't be a dumb bear. Don't be a dumb bear.
So buying is selling, right?
Well, buying means you're paying a premium and you're just going to lose the premium if you're wrong. When you buy a put, you have a choice to sell the stock. When you buy a call, you have a choice to buy the stock. You have a choice to put the stock or a choice to call the stock. And if you're wrong, you just lose your premium. So it's not C or D. A is an obligation to sell the stock, and B is an obligation to buy the stock. And so now what is a more potential loss situation? To be obliged to deliver the stock or to be obliged to deliver money?
The stock.
That's right. So
it would be, is that B?
It's no, delivering the stock is writing a call. You have an obligation to deliver or sell the stock. Somebody can call it away from you. Right. So writing a put is an obligation to buy. There you just, worst case, you got to have cash equal to the aggregate exercise price. Right. So it's I like this answer set, by the way. So those, remember that we have two types of options, calls and puts, and you can either buy them or sell them. And so, as I always say here, I think this is the most important thing at some point. It's not going to be a big deal on the SIE, but it will be moving on, is to be able to look at a lot of
questions on it.
Yeah, this is an obligation to sell the stock at the strike price. Right. So I call this contract specifications. And so that's why I like this answer set, because these are, our choices here. We're receiving the premium. And if you're receiving the premium, that's why you're obliged, right? If you don't want to be obliged, you shouldn't have done it, right? So I always tease, right? You, Allison, are long a tutoring session. You did an opening purchase. You have a choice, but not an obligation. I'm the person who collected your money, so I'm obliged. If I wanted to spend a couple hours with you on a Sunday, I probably shouldn't have collected the money, right? This one is an obligation to buy the stock at the strike price. And again, that can hurt, but that's not unlimited sums of money. I said, the worst case here, somebody's going to stick it to you at the strike price, and you're going to have to come up with the money to pay for the stock. That's definable. That's definable. And then these two, right? This is a choice to sell or choice to put the stock at the strike price.
Yeah, choice to sell.
Right, whether you want to have a choice to buy or choice to sell, choices cost money. And this is a choice to buy the stock at the strike price. And those are our four option positions. We have two types of contracts, calls and puts. You can either buy them or sell them. Now, if we look at this, we can also say, sell the stock, sell the stock. You wouldn't want to sell the stock unless you thought the stock was going down. Right. And so,
but it's A because you have to, right? Versus
that's right. That's exactly
got it. Okay.
Right. That's bearish. As I said, don't be a dumb bear. This is a smart bear who bought the put, because if he's wrong, he just loses the premium. He doesn't have to deliver the stock.
When you're writing calls, is that
writing
puts, is that cheaper?
No, writing a call short. No, well, you could write the call to pay for the put. It's not. You're bringing money in. This is money in.
Got it.
And this is money out.
Opening sale.
So it's always more dangerous to, be having money in. Now, if we look at these other two again, so we're looking here. If we look at this, we have buy the stock and we have buy the stock. And you wouldn't want to buy the stock unless you thought the stock was going up. So we have two bullish positions and two bearish positions. And again, we have a dumb bull and a smart bull. We're kind of hinting that it's better to pay a premium, because if you pay a premium and you're wrong, you just lose your premium.
If you pay your premium, yeah, agreed.
But, pretty easy to qualify somebody who wants to either buy a put or buy a call. I say, is this money you can afford to lose? Right? So, here you're paying the premium for the choice. Choices cost money.
Got it.
So I really like that answer set. I don't particularly care for the question. I mean, the question's okay too, but I just think that answer set is definitely something you're going to encounter.
I think I saw it. I saw something like this on there.
There you go.
Because it's very general.
When an associated person, while an associate may work for an entity other than a member firm, the employing member firm's permission is.
Other than a member firm.
So
when they say other than a member firm, are they talking about
that means you want to work somewhere other than
right?
That means any other that's called outside business activity. So you're for pay going to do something not affiliated with Blackstone.
I think it's required.
Well, don't you love it? This is where you get in trouble just because the house requirements can always be more stringent.
Yeah.
It's not required. What is required is you make a written notice to Blackstone of your outside business activity. So it's not required.
That's yeah.
But it's written notice is, what you got to do. And then based on the written notice, they will either say yes or no, right? They might get the written notice and say, nah.
Yeah. And at Blackstone, it is required. I think that's what's screwed me up.
Yeah. I can't imagine it isn't. I mean, I always joke, if you're a compliance officer, listen, if I'm a compliance officer, I say, Alice and I have 3 buckets. One bucket is it could be a problem. Another bucket is it is a problem. And my third bucket, my favorite bucket, it'll never be a problem. If I don't let you engage in outside business activities, I will never have a problem. So almost every firm, Alice, in your point, is going to say, nah, I don't think so.
Yeah.
If a 40-year-old customer earns $85,000 a year and his 38-year-old spouse earns $140,000, how much may they contribute to individual retirement accounts?
It's $7,000 a year. Is it D?
Yeah, good job. Right. That's what, whatever that is, that's what they can contribute.
They can contribute separately. Yeah.
Yeah. The Windmill Growth Fund has breakpoints of 10,000, 25, and 50. Your customer places an unsolicited purchase through you of 47. You placed a trade as requested without question or comment. This action is.
I think it's C or D. Or it could be a rules violation. Let's go with B.
Yeah, that should be kind of your default. That's called a breakpoint sale, whether it was unsolicited or not. What I should say is, hey, Allison, do you know that if you come with another $3,000, you'll get a reduced sales charge? And you say, well, Dean, I don't have $3,000. They go, well, hey, Allison, we've got letter of intents. If you'll tell us that you intend to come up with $3 more grand in 13 months, we'll let you in at that lower sales charge. So that's called a breakpoint sales. Breakpoints are good. That's the client discount. A breakpoint sale is a big no-no, right?
Breakpoint sale is
yeah, where you're trying to maximize the commission by avoiding the breakpoint. So you got to believe in human depravity, even though this is unsolicited. If I call you, it's going to reduce my commission if I get you to sign a letter of intent, right? So I'm supposed to call you though and say, hey, Allison, I'm going to do what you tell me because you're my customer, but I would like to let you know there's a better deal available. By the way, I can still enter the trade because remember the letter of intent can be backdated 90 days. So I said, hey, Allison, I followed your instructions. I bought you $47,000 of the Windmill Growth Fund, but I just want to let you know that there is a breakpoint at 50. And, if you come up with another $3,000, and you go, well, it's too late. I go, no, it's not too late, actually, because we have what are called letters of intent that can be backdated. So if you'd like, we can go ahead and backdate this thing and get you a reduced sales charge.
But it's your obligation to tell them.
Absolutely. Disclose.
Yeah.
Right?
Yeah.
Sunlight is the best disinfectant. For the primary market, which of the following is true? So we have a primary market and we have a secondary market.
Primary market. I thought secondary market is the UX exchange, but am I wrong? Is this D?
No, that's a bad miss.
Okay.
So, excuse me. You're correct. It's D. Well, but no, you're not. It's not D because it's not all U.S. exchanges.
Okay.
Right.
So is it
New York Stock Exchange is secondary trading, right? So the last part of this is true, right? But it's the issuers that are raising the money, right? So issuers' transactions occur because they're receiving the proceeds and are offered the public offering price, right? So not a bad miss, but it's not all U.S. exchanges.
Okay.
Right. New York is secondary. So that was actually C. Which of the following is not part of a mutual fund's expense ratio? Not part of a mutual fund's
transfer agent costs?
Mutual funds expense ratio.
12B1 fees are
Right on.
transfer agent cost. I don't know what that is. Sales load, I think, is true. Between C and D.
But it's neither. It's the sales load.
Or not.
Yeah, right. The sales load is paid by the customer, not the mutual fund. The mutual fund pays 12B1 fees, promotional expenses. The mutual fund pays the transfer agent. The mutual fund pays the manager. The mutual doesn't pay the load. The customer pays the load. The customer pays the load.
Okay, so the transfer.
Yeah. And then what's the maximum sales load? What is the maximum we can charge somebody for a mutual fund?
Don't know.
8.5%.
Oh yeah.
Yep.
Yep.
That's the max.
So the sales load's paid by the customer.
Right. Which of the following rights are specific to holders of ADRs and are not available to owners of domestic common stock?
Well, common stock has dividends, so C's out.
That's right.
Right to pay taxes, the right to convert. And not available. This is a hard one. Not available to owners of common stock. I don't know where you would transfer shares of common stock to, but
Well, what that means, can you sell your ADR or your stock to someone else? You can. So both of them have D. We're looking for something that is unique to the ADR. Both of them, you have a right to a dividend if declared. You have a right to receive dividends if declared. I don't like that you have
the right to pay taxes.
Well, yeah, that's kind of funky language for sure. But you're
Right.
all going to pay taxes on that. Only in an ADR can you convert into the underlying asset. You can say, send me my shares of Telefonos to Mexico.
Got it.
Because in a regular stock, you don't have that. An accredited investor is one who meets which of the following criteria?
Professional designation. What is that? Like,
well, I've got, if you're not already an accredited investor, that is a Series 7 in good standing. If you're a Series 7 in good standing, you are an accredited investor.
Got it. Got it. Never heard that. I mean, it's C or D, but I never heard of.
Yeah. Yeah, there you go. C or D.
But just because you have a Series 7 doesn't mean that you're accredited, right?
It does. Yeah. No, it does. It's part of the definition now. Yeah. Part of the definition now. Yeah. What is the income? Do you remember the income? Very testable.
The income is 200,000, and then if you're with someone else, it's 300,000.
Excellent. Excellent. What's the net worth?
Net worth is $1 million, doesn't include your house.
Perfect. And then remember, the point of being an accredited investor is you can accept an invitation to participate in a exempt transaction known as there you go, private placement, right?
Private placement. Yep.
There are two of them, right? There's 506B
and C.
C, right? 6C, B, you can have B as in boy, you can have 35 non-accredited investors, can't solicit. C, you can have no non-accredited investors, but you can solicit. All the following are considered control persons owning control stock, except. So one of those persons is not subject to the volume limitations under Rule 144. And the other three are subject to the volume limitations under Rule 144.
Is it A or D?
You're correct. It is A or D.
I don't think a board member. So I'm going to go with A, an unaffiliated shareholder.
Yeah. You remember what's the number to become affiliated?
I think is it 10%?
The 10% or more. That's right. 10% or more. Excellent. All the following are considered to be major credit rating agencies except.
So B and C are definitely major.
Right on.
Finch, I think, is major. Is it A? Is this a
yeah? There's no such thing as such thing as you. Yeah.
I was like, is this a trick question?
Well, it is because A doesn't exist. There's no such thing as that.
Okay, good.
Then remember, below triple B is less than investment grade.
Below triple B, yeah.
Right.
Like BBB.
There you go. What is the purpose of Rule 5130 regarding restricted persons and IPOs?
5130. Maybe B, I don't know.
Wait, if we didn't have 5130, you'd never see the good stuff because we would keep it for ourselves. You say, hey, Dean, it must be pretty cool to be an associated person, a broker dealer, and get first dibs on all those IPOs. I said, well, Allison, it's actually the opposite.
You
As
can't,
an
right?
associate person, I'm restricted in terms of IPO allocations. That's to make sure, Allison, we make a bona fide distribution to you, the investing public. If we didn't have this, I'd be keeping all the good stuff, right? So this is about who can have an IPO allocation, who cannot. So the reason we put this in place is to protect the integrity of the public offering, right? And protect public investors to make sure that we're making a bona fide, good faith distribution of the securities to the client. I always think of this as in the context of like cars, early in the years ago, the BMW came out with this car called a Z8. Oh, this thing was gorgeous. And I saw 8 of them in the Bay Area, and 5 of them had dealer plates, meaning the dealer was not actually selling those cars. He was sitting on them. I have a Ford friend. He's a Ford dealer, and he's withholding the GT350. He's keeping it for himself. In our business, we would tell that BMW dealer or that Ford dealer, listen, you got to put the Z8s on the lot, and you got to sell them at the manufacturer's suggested retail price, and you can't sell it to an employee of this dealership, an accountant or attorney to this dealership. You have to make a bona fide distribution of that automobile to the public. Now, as I said, I don't think the car dealers have a code of conduct. And, if the Ford dealer wants to put the dealer plate on it and drive it home, that's completely up to him. But in our business, we say, no, we're not going to do that. Which of the following accounts would the use of margin always be prohibited?
Is it B, retirement accounts?
Yeah. You're not supposed to leverage up your retirement.
No, it's for retirement.
Yeah. A customer of a broker dealer purchases 100 shares at 50 on Monday. Later that week, a confirmation arrives electronically indicating the total cost was $5,000. The client is puzzled that there's no additional charge for the commission. The most likely reason for that is
It's A or C.
You're correct.
Is it an agent or a principal? Oh, this wording is always so hellish.
Well, remember that whether you could, you're on the right track because
I'm assuming maybe agent in the trade.
No, agent means I'm going to charge you a commission.
Oh, so principal where you're
That's
not.
right. ABC, agent, broker, commission. ABC,
okay.
Agent, broker, commission. Principal, I charge you a markup or markdown. So the answer was A.
Is a fee.
Yeah, getting commission, right?
Principal is not.
That's right. You're going to pay the ask and no commission. When the supply of money exceeds the demand. So we worked on economics the other day. So let's see if it pays us any dividends on this question.
For the supply money exceeds the demand when.
I always think of this as rent on money, right? So, if the supply money exceeds the demand, that means to me, the way I think of that is I'm not going to have to pay as much for it.
Well, that means interest rates are going to fall.
Right on.
And then it has to be making customer borrowing easier.
Yeah, that's all. People borrow more at low rates, right?
Oh, I know this is going to sound stupid, but this is how it was explained to me by my fiance.
Yeah.
If shoes are above $100, you're paying a premium. When shoes are below $100, you're paying it at a discount.
There you go. Right? And then remember, there's I think particularly in ladies' fashion.
Yeah.
In ladies' fashion, sometimes those fashion houses will restrict demand intentionally.
Yeah.
So, so when I'm, not doing whatever, I'll watch some of these reality shows with mom. And she writes the Real Housewives of Beverly Hills.
I do.
And they'll have like some bag, and I'm like, really? That bag is $60,000. That's crazy.
Yeah, if you could get into anything, it would be buying Hermes.
Yeah,
bags. I'm sure
there you go. Yeah,
profit
secondary
there.
market. All right, now the opposite. Let's just talk about the opposite.
Sure.
When the supply for money it exceeds demand, it would be right. If the demand exceeds supply, that would be the opposite. So if the demand exceeds it, then interest rates are going up, and it makes consumer very difficult.
Got it. Okay.
Your client has $250,000 to invest. His objective is a lifetime monthly income. That's a hint. Part of his customer profile stresses he has had uncomfortable experience in the stock market. Another hint. He's not inclined to invest in anything that is subject to market fluctuations. Another hint. Based on his profile, what should we say to him?
Does a treasury bond have, he wants a lifetime. Does that get?
Yeah. He wants a lifetime income. That's kind of key.
Between D and mutual fund bond. Fixed annuity is an insurance product, right?
Yeah, and then why would you buy an insurance product? Like, why do you buy fixed annuities?
That fluctuates.
Well, the fixed annuity doesn't fluctuate when you.
Oh no, that doesn't fluctuate. Sorry, I'm between A and D.
You're correct. It's either A or D.
A fixed annuity, though, do you get dividends on that?
Well, it doesn't say anything about dividends in the question.
Well, it says he wants to a part of the he wants
a fixed annuity. What you do in a fixed annuity, that's the answer. Is you give the insurance company $250 and say, what will you pay me as a monthly income on my $250? And they say, well, we'll pay you, $1,000 a month or $2,000 a month, whatever the case may be.
So it's A.
Yeah.
Why isn't it D?
Because a treasury bond fund has interest rate risk. If the interest rates go up, the treasury securities go down. Right? It says uncomfortable stock, not inclined to, it's subject to market fluctuations. And treasury bonds go up and down based on interest rates. If interest rates go up, treasury securities go down. That means the NAV of the treasury bond fund is going down.
That makes sense.
The maximum gain on a long call is.
So
again, what I'm hoping that at some point we see long call, we say this is a choice to buy the stock at the strike price.
Choice to bullish.
It's bullish indeed. So if you're right, the stock goes up. How far up could the stock go?
Stock. Is it unlimited?
Right on. Right, because if I buy an Apple 190 call at 5 and Apple goes to 200 or 300 or 400, I can buy the stock at 195. So unlimited.
Honestly, I got this one because this is like one of them is not like the other.
Yeah, well, listen, test taking tricks. No, that's fine. That's fine. But you should know that anytime you buy an option, the max loss is your premium.
Oh, the max loss is the premium. Okay.
Right. And then you should know call up. This is the break even in a long call.
Yeah, we're gonna need to do like an hour or so on that.
Okay. Yeah, this is break even and a put. Right. So again, I'm just pointing out I like the answer sets because the answer sets, depending on the question, could depend on what.
No, these are really good. I know they use videos on that, and I will listen to that.
Yeah, the answer sets are pretty good. A customer purchased 100 shares of GHI common stock for 20. After a year, they sell the shares for 23. Over the past 2 years, GHI has paid 25% quarterly dividend. What is the total return? So here we go again. So do you recall how we go about solving this?
So they got $1 back.
They got $1 back, but be careful.
Well, it's
2 years. 2 years, right? So if you got $1 every year, that's $2.
Okay, so they made 5.
Right on $2.
2 plus
an income.
Yep.
Plus $5 or $3, excuse me,
$3.
in price appreciation.
2.
So we made $5. And then remember what we're going to do next?
Then you take So it'd be 5 divided by.
Yeah, if you can't decide what to do, you should always divide. And if you can't decide what to divide, take the first number and divide it by the second number.
Is it 2,000?
Yeah, so we're going to take our, well, what do we pay here? Yep, 2,000. So now we're going to divide by 2,000. Boom. And we should come up with one of those answers. So let's get out our calculator. Whoop.
Let me get mine out. Hold on.
So we made $5 on $2,000.
It's C.
Yeah. Well, wait a minute.
25.
That's where it's after a year. Kaplan are jerks. So after a year, they got me. So it said over the past 2 years, I took the $2.
Oh, it's actually.
Yeah, right. Because I went for this. I'm just checking my math here. And I said, okay, well, hold on. What I got is not available. So I jumped on that. And it said they had it a year.
After
so now we got to reprocess. So now we say, okay, we didn't make $5. We made $1 from the dividend. Plus we made the $3.
Oh, so it's 4.
Yeah, it's $4. So we made $4. We're going to divide that $4 by 20. And let's do that. $4 divided by 20. Yeah, 20%.
It's A, I think. Yeah.
Yeah.
I bet you this one a lot of people get wrong.
Well, yeah, you got a RTFQ, deemed an RTFQ. Opening a margin account where a client requires the client to do all the following except.
Is it D? I don't think you need to receive the risk disclosure until.
No, it's the loan consent form. We say Allison would like to lend your securities to our customers who wish to go short. And you say, well, Dean, I don't think it's in my best interest. Yeah, it's C. Yeah, my best interest to lend my securities to the people that want to go short. I say it's not, Allison. So the loan consent form test question is optional. You don't have to sign the loan consent form. You do have to receive the risk disclosure. Right. And your point, you made up a timeline that isn't there. It didn't say before or after. It just says you do all the following. You have to sign the credit agreement, you have to sign the hypothecation agreement. The credit agreement is where we tell you that you understand you're borrowing money and paying interest. The hypothecation agreement is where we tell you understand you're pledging your securities as the collateral for the loan. And loan consent form is the optional thing, and then risk disclosure.
That was a miss.
Yeah. If a registered rep is involved in a securities transaction outside the scope of your employment with the firm, a practice known as selling away and will receive compensation for it, which of the following must that representative be properly supervised for the transaction?
Which of the following must? Is it C, where the trade took place?
No, it's your employing firm is the one who has to make sure they're supervising it.
Oh, interesting.
Right. It's
Yep.
Yeah. So this is where I'm trying to build like a health club. I'm soliciting my broker, my Blackstone clients to fund the thing.
Yeah.
Right. And Blackstone says, okay, well, we would like to keep track of what you're doing, because again, in the real world, unlikely they're going to let you do that. Your customer purchases 5, Gem 50 calls at 3. Funds must be deposited in the account to pay for the trade no later than. So they're asking you here, how do option contracts settle?
Shoo.
Bless you.
Thank you so much. It's A, B, or D. Obviously, you need funds for it. Is it the next business day, though?
Yeah, options, treasuries, and now all securities settle next business day.
It has to be, yeah, T
plus one. All of them. DFA Income Fund has a public offering price of 75.
Sure.
And an NAV of 70-75. What is the fund's sales charge?
So the pop is 75.
Mm-hmm.
The NAV is 72.25. It's pop minus NAV, right?
Right on. You're gonna take the 75, you're on the right track, minus the 72.75. And that
75
gets us
yeah.
325, I believe. Boom. And again, I'm terrible at arithmetic, so I'm going to check that with my calculator.
Let's see.
75 minus 72, 75. Indeed. Oh, good thing I checked. It looks like Dean would have missed it. 75 minus 72,
It's
75.
2.25. Interesting.
Yeah, good thing I used
It's
my calculator, right? Because good thing I went back and used my calculator. Somebody offers me a calculator, I'm going to say thank you very much. So that is the sales load. Now we better not come up with something more than 8.5% because that would be a violation. And so now what we're going to do is we're going to take the sales load and we're going to divide that by the public offering price, which in this case is 75. And that will give us the percentage sales charge. So 225 divided by 75. It should get one of those answers, and we get 3%. Boom.
Yeah, 0.03.
Yeah, I like that one. That was a good one. In fact, that's so good, I think I'll write it down so I can share it with others.
75.
One SIE.
This is a good one.
148 3190. Calculate percentage sales charge. All right. 222.
I'm doing it okay.
Yeah, we'll see. Yeah, we'll see how you do. Like I say, it's just a mark, an intellectual inventory, see where you're at. So we can plan accordingly. An investor owns a 4% preferred stock participating to 6%. This means the investor
It's C or maybe D. Or is it 6 and 4? Ooh. I'm gonna go with actually the opposite. I'm gonna go with A.
It's actually C.
Is she? The
Yep.
2%. Oh, I knew it.
Yeah, right. Up to 6 or total of 6,
I
right?
should have went
So,
with that one. That's
yeah,
okay.
that's all right. All the following may be purchased on margin except
D you can.
no, you can't. You can't
Oh, you
purchase.
can't for options?
I'm not lending you money to buy options. Are you crazy, Allison? If you want to buy options in your brokerage account, you got to pay in full.
You have to pay cash. Yeah,
We do
sorry.
not extend credit. We do not extend credit on options. They're ineligible for purchase of options. There's exceptions, but not on the test. Broker dealer's business continuity plan to be enacted in the event of a significant business disruption requires all the following except.
C is you have to.
That's right. I like how you're attacking here, right? Process of
Yeah.
elimination.
You have to have another physical location. I know that.
That's correct.
Yeah. I don't know if you have to notify regulars within an hour.
You do not.
Yeah, that sounds like crazy.
Right. Yeah, they have to tell customers how they're going to access their accounts.
Yeah.
Right. You should know that we have to post that, either a link to how to get it on our website or the actual plan. So for a copy of our business continuity plan, send us a letter or whatever.
Has to be on the website.
Yeah. Which of the following pairs of option contracts
God.
is not in the money if the strike price is 40 and the market price is 30? I like to do what Dean likes to do is untestable, but I always like to put the market price either above or below my strike, just to make my analysis a little easier. So I'm going to put that 30 underneath there.
So 30 is, and CMP is the
Current market price. That just means
current market price. Okay.
And it's asking and not in the money. So no intrinsic value.
Not in the money. This one I don't know.
We have a good mnemonic device for intrinsic value in the money. Call up, put down. So for a call to be in the money, the market price has to be above the strike price. In other words, a choice to buy at 40 with the stock at 30 has no economic value. That 40 call, that short 40 call is going to be out of the money, right? Because again, for the call to be in the money, the market price has to be up here somewhere. Call up. The market price has to be, for a call, above the strike price. And so the short call is going to be out of the money. And so that means it's either A or C. Now, for a put to be in the money, the market price has to be down from the strike price. Call up, put down. Is it likely that I'd like to stick the stock to you at 40 if the stock is 30? Absolutely. Well, that does make some economic sense to stick it to somebody at 40. You say, Dean, you're making me pay 40 for a stock that's only worth 30? I go, yes. You didn't want to do that. You shouldn't have done this put contract. Again, it's asking me out of the money. So we know it's going to be a short call, not a long put, which is not in the money. So we're being asked about out of the money. So it's going to be short call, boy, and then long call. Yeah, it's going to be the long and short call.
Oh, it's A.
Right, because it doesn't matter what side you're on. It doesn't matter whether you're long or short. The 30 put is in the money, whether you're long or short. By the way, this is, again, it's a tough one because Dean was shopping the answer set. I'm going, yeah, these are some weird ones, right? So the call contract, the put contracts are in the money.
Oh, the put.
And the put contracts are out of the money. Right. That was a tough one.
You have a lot of, option questions.
Tough one. Which of the following retirement plans does not require a RMD once you reach the age? It shouldn't say 72, it should say 73, but it doesn't matter. Which one of these does not have a required minimum distribution? This is testable.
Well, a 401k and a traditional IRA both have a minimum.
That's right. I like where you're on the right track.
A Roth, I feel like 403B is I'm trying to remember what that is. I didn't think a Roth has a minimum, but maybe they do.
No, they don't. That's the whole point
Roth
of Roth.
doesn't. Okay.
Oh, yeah.
What's a 403B again?
403Bs are for employees of educational institutions or nonprofits. Saints and teachers, right? People who are working at a school are working at a nonprofit hospital.
No minimum.
Right. And they are using pre-tax money.
No minimum until 73.
Yeah, that's right. Those are when we say, okay, listen, it's time to get your money out of there so we can tax you.
Yeah, that makes sense.
On Tuesday, December 10th, your customer bought 5 OEX 230 March calls at 4. On Tuesday, March 10th, the calls are in the money and your customer issues exercise instructions. On what days did the trade and the exercise settle?
So for December, I think it's same day.
No, it's
Is
T
after-
plus 1.
Oh, it's the next day?
Options and governments are T plus 1.
Uh-oh. Okay.
So it's December 11th. That's when that
Got
money
it.
came out of your account.
T plus 1. And then I guess it's B.
It's going to be the next day for both of them, right? So it's A,
Yeah, March.
right?
Oh, sorry. Yeah, sorry. 10.
Oh, yeah, T plus 1 for both of them.
Yeah.
An investor has purchased Class A mutual fund shares. The NAV per share of the fund is the price the investor
Redemption of the shares. Is it A?
right on. Good job, right? You pay the public offering price and you get to retain NAV when you get out. Good job. In a defined contribution plan, so we have two types of retirement plans that employers offer. Some employers offer old-fashioned defined benefit plans, and most employers today offer defined contribution plans. Oh, excuse me.
Bless you. The benefit amount. I think it's fixed.
That's from the employer standpoint, you are correct.
Like it's like 3%, none.
Yeah,
like,
right on. 401ks are the ones most people are familiar with.
Yeah. So
and that is correct.
The contribution, though, that can vary depending on what you're invested in. So it's 1 and 4, I think.
It's actually 2 and 3. The benefit is variable because remember, whatever you put in that 401k, whatever it grows to or falls to, that's what you get. So the benefit you're going to receive is variable.
It's the opposite.
Right. And the contribution that your employer is making is fixed. Your contribution can vary, but if like Blackstone promises you a match on your first 1% or 2% or 3%, then that's fixed. So it was 2 and 3. So you are on the backside of the question.
Got it.
Which is better as your tutor? I prefer that than you're in left field somewhere. The primary regulatory body for the securities industry would be which of the following?
I had a question like this on the exam.
Good.
I always view the primary as the SEC.
Well, they're God, right?
They're God.
And state administrators think they are.
Yeah, is it fair?
No. But remember, the SEC has a broader, your point. They're not God just over the securities thing, but you're right. They're God of everything, right? Right. So you're correct. It's the SEC. And then remember FINRA. Every once in a while the SEC gets into it with FINRA. And I always joke, I think it's like the mom conversation. The SEC says to FINRA, we brought you into this world. we can take you out of this world, right? So I always think it's funny when the SEC suggests something like D+1, and then FINRA says, "Oh, well, study it," and da da da, and then finally the SEC will just say, "Hey,
you're going to do this."
Yeah, make it happen, right? So anyway, so yeah, you're right. It's A.
The self-regulatory body is FINRA.
Yeah, if they said, what is the self-regulatory organization for the securities industry, that would be B.
And
they said, who is the primary regulatory authority for banks? That would be C. And if they said, who is the regulatory authority for municipal securities? MSRB. And remember, the MSRB has no enforcement power.
FINRA doesn't either, right?
FINRA does. FINRA can fine you. They can suspend you.
Oh, they can fine you. Yeah. Okay.
They can do things. Can't throw you in jail, though.
They can't throw you in jail. Sorry. Yeah.
Can't throw you in jail. An official statement is a disclosure document that would be used in connection with an offering of which of the following. This is testable.
Official statement. Ooh, between A and C. Guess it could be D. But I'm going to go with B. I don't know.
Yeah, muni bonds are exempt from 33. So if they're exempt from 33, that means no prospectus, right? They're going to use instead official statement. It serves the same purpose. It helps you make an informed decision. An informed decision.
Oh, they don't have prospectus. I forgot.
That's right. An amended form U5. Ooh, so U5 means you're leaving firm A.
Yep.
That's U4. I always joke U4 is hello and U5 is goodbye.
Yep.
Right.
An amended U5 must be filed and copied, sent in how many days? Oh, I think it's 30 days.
Right on.
Yeah. 10 days, it's right. If it's like
yeah, if it's like a big thing.
If it's like statutory, exactly.
Right on. The principal demand side theory were laid out in a 1936 book. This drives me nuts. The General Theory of Employment, Interest, and Money, written by whom? Well, he is the only.
I only know B.
Yeah, he's the only economist that showed his name. Keynes, yeah, demand side, right? Keynes.
But I didn't see that on the test.
Yeah, I didn't. Nobody would there. Yeah, this is whoever wrote that question, Kaplan. I think this is a little full of themselves. A convertible feature for preferred shares allows the owner to exchange the shares.
Oh, is it fixed? No, it's for bonds.
Yeah, a convertible bond feature, but it could be convertible preferred. It could be convertible preferred too. We have convertible bonds and we have convertible preferred. So this is a convertible preferred. You can convert from the preferred shares into
common, right?
Yeah, right on. Right, and that number of shares you can get is called the conversion. This is
worded, yeah. This is for a fixed number of shares, yeah.
Yeah, right on.
Preferred.
Shelby Bowden, your client, purchased a 6% bond with a current yield of 5. The bond was purchased at. So we usually recommend using the teeter-totter or seesaw.
Okay, so you're purchased 6% with a yield of 5. So I know this is gonna. So you bought the shoes.
There you go.
At a higher price than what it's currently selling.
That's right? Exactly right.
So you're paying a higher price. You're paying a premium.
There you go. Excellent.
Yeah. I know this is...
Yeah, you could tell your fiance, hey, it worked. I tried the shoe thing and it worked.
Oh my God. Yeah.
The Sierra Verde Coffee Company recently developed a new flavor, jasmine chili salted mocha. Unfortunately, the coffee has a horrible taste and the company discontinues the flavor. The costs involved with bringing the new product to market, combined with a drop in sales and a reputational hit, has translated to a significant drop in the price of the stock. This is an example of what type of risk?
Well, it's A or C.
It's correct.
It's probably business risk.
Yeah, that had nothing to do with the market.
It's
That's
nothing
just
to
you
do with
being
the market.
idiots, right?
I think them throwing the stock though in there kind of can confuse you.
Yeah. It has nothing to do with the market, right?
No, it's business risk.
Business. A customer called you and asked you to place an order for 200 shares of ABC stock. Which of the following is true regarding this transaction?
Well, it's solicited. Oh, I'm sorry, it's unsolicited.
That's right. So it can't be D. So
D
we're
is
looking for the opposite. Yeah.
This is a discretionary trade. No.
That's out. You're correct.
This is definitely not a recommendation.
Perfect. I love the way you take that.
Sorry,
Perfect.
yeah.
Perfect way to do it. Process elimination. Under the Investment Company Act of 40, which of the following is not considered an investment company?
It's a hedge fund and investment company. It can't be.
That's right on. Hedge funds are purposely designed not to
they're
be.
they're under
they're private. Yeah, that's right.
Yeah.
All the following self-regulatory organizations.
There we go.
There you go. Function under the SEC oversight, except.
I think I got this question on the exam or something very similar. All of the so D is true. Oh, I have all the
D is most certainly true.
Yeah. I don't know what the Chicago Board Options Exchange is.
Well, keyword exchange.
Yeah, so it's on okay.
People and places, right? 34.
So SEC is definitely overseeing that. Federal savings and I mean, I'm assuming it's A or C.
You're correct.
For some reason, I don't think the SEC oversees the municipal security.
Well, they do. It's still securities.
They do? They don't oversee banks.
Not the issuers, but the people who are selling them us.
Got it. Okay, so it's A.
Yeah. And that's would be the FRB.
That's a good one.
Which of the following is the highest bond rating?
AAA.
Right on.
A.
Which of the following is part of the expense ratio of a mutual fund?
You just went through this. So
yeah, this is kind of the same flavor of question. So this is the opposite version, right? The last one asked you to recognize things that are paid by the client and not the mutual fund. This is asking you to recognize things that are paid by the mutual fund and not your client.
Well, B is paid by the client.
Yeah, C is not. Remember, the mutual fund pays the board.
Yeah.
Right. The contingent deferred sales charge. What share class has a contingent deferred sales charge? What share class? A, B, or C?
A deferred, is it C?
The B shares.
Oh, B, okay.
Right?
Because
that's
A is paying up front.
That's right. A is you pay front load.
Deferred. Okay.
That's
and then C is
for somebody who doesn't want to have a long-term exposure because the expense ratio is higher, the promotional expense.
Got it. Okay. So which is okay.
All the following are benefits of a traditional IRA except. So one of the things is not a benefit of a traditional IRA.
All the following are benefits. So let's start with that.
So we're looking for something that you're not going to like.
Well, contributions are not tax deductible.
For traditional IRA, well, they may or may not be deductible. Depends on how much you make. Or whether you have access to a retirement plan elsewhere.
Yeah. No penalty is charged for failing to withdraw. No, there's a penalty.
Right on. That's it, right?
Yeah. This is also like one of these are not like the other. B is
right. Exactly right. Exactly right.
Yeah.
Which of the following is a lagging indicator? So remember, past tense, something about where we have been, not where we're going, not where we're at, somewhere we have been.
Increase the thousand. C is out. Increase in hours you worked. ED. or hours worked, decrease in industrial. A lagging indicator, decrease in. Between A and C.
You're correct.
I'm thinking A, decrease.
I go for too long to be wrong. Too long to be wrong.
Oh, it was C?
Yeah, it's C.
Increase in the, why,
Yeah, yeah.
Why is it C?
Because decrease would be telling us where we're at, right? Increase would be telling you that we're actually what's going on, right? People are buying more stuff on installment. So I wouldn't worry about that one. The one that you get tested on is leading economic indicators, and that's going to be stock prices. So wouldn't spend a lot of time trying to memorize indicators.
Stock prices. Yeah, I got one on leading.
Yeah. ABC Corporation stock is trading at 35. A client purchased a 50 call. The option's current value is made up of.
I think it's C or D, intrinsic value.
It has 0 intrinsic value, right?
Oh, interesting.
Right, because it's a 50 call for it to have intrinsic
Oh,
value.
for 35. Oh,
call up. The market price has to be up. Right now, buying it at 50 has no economic value. So if you buy that, we say all you're buying is time value.
oh, A.
Right? There's no intrinsic value.
So if the call is higher than what it's trading at?
Yeah. Yeah. Usually it would be this. The premium would consist of the intrinsic value and the time value.
This one was a good one.
Yeah, tough one.
That one's a real tough one.
Right. But it looks like we're getting heavy options here. An August 15 call is written at 4. The call expires without being exercised by the owner, the writer of the call. So you said that for $4, you would deliver that stock at 15. Nobody makes you deliver the stock at 15.
You have the choice.
No, you wrote the call. You were obliged to deliver that.
Oh, you have to. Okay, so it's
then they're saying the owner, the person who was long, did not exercise that call.
It's a writing. Yep.
So you wrote the call, it expired worthless. So what does that mean? Are you happy or sad?
You are call expires not without it. You're sad.
You're happy. You get to keep the $400.
Oh, you get to keep it.
I say, Allison, remember we wrote the 15 call at 4?
Mm-hmm.
Remember that $400 that came into your account?
Yeah.
You're writing the contract. I, Allison, agreed to sell the stock at 15. I say, Allison, you did not get exercised. The call expired worthless. And so when you sell options, the best case is you agree to be a potential victim. Nobody victimizes you. You keep the money. You go neener. You get to keep the money. Which of the following is true regarding a registered person who wishes to move her registration from one broker-dealer to another broker-dealer?
You need a U5.
Yep, you got to disassociate from broker-dealer, your old broker-dealer, right on.
Yeah.
So which of the following is true regarding who wishes to move a registration to another broker-dealer?
Has to be C, because there's only a nurse can, no. Is there a mistake in pass? A person who has been registered?
Yeah, this one is kind of crazy.
Wait. I think it's C.
Only Form U5. No, because you're going to have to do the U5 and then an amended U4.
Yeah, and then you need an amended one.
So yeah, so C is not correct.
Interesting.
It says that only Form U5 is needed.
So A is out, C is out.
Yeah, this is funky language.
This is weird.
In no circumstance can a registration. Yeah, it's actually A, but I don't like the question, right?
Sorry.
Because you're not transferring your registration. We're ending your appointment at Blackstone.
And then
period. Then you're doing an amended U4. So you're not transferring the registration. You're ending your association with Blackstone.
Oh, got it.
And then beginning a new association.
It's just written weird.
Yeah, I'm with you. Grammar on that is atrocious.
Yeah,
atrocious. Listed options settle. You've had like 3 questions on this thing.
C plus 1.
Good job, right?
And there'll probably be questions on this.
Oh, absolutely.
Yeah.
While the MSRB writes rules and regulations regarding underwriting and trading for municipals, it does not enforce those rules. Who does?
Is it FINRA?
Yeah, that's what FINRA they want to
Okay.
enforce us. A corporation has a shareholder meeting coming up, wherein several controversial proposals will be made. A number of persons will be actively soliciting proxies, and the corporation plans to send out up-to-date material on the proposals to the shareholders to prevent them making informed. Which of the following must review this material before it is sent out?
Review the material?
Yeah. Have you ever heard of such a thing?
I don't think it's the SEC. Is it the SEC? It's A or D?
It's A or D. That's right. So make
It has to
informed.
be
Which
A.
of the yeah, it's again the SEC, right? Upon termination, a member firm must file a U-5 in how many days?
Oh, termination? It has to be
Yeah.
10
So
days, right?
yeah, how? No, it depends on the circumstance. Remember, it
Yeah.
depends on.
Then
So
30
just,
days.
yeah, it's just in the normal course of business. It's 30.
Yeah. Termination, I think something bad,
Right.
something
You're right.
bad happened.
A customer purchased 100 shares of M&O common stock 2 years ago for 20. They now sell shares for 23. Oh, I think we got to repeat. Oh, no, now they're not asking us
No, this is
percentage.
different.
Yeah, 100 shares. They now sell for 23. Over the last 2 years, it's paid. What is the result of this closing transaction? So yeah, looked like the same question, but it's not.
Well, it's short term, right? Because it's only 2 years.
That's right. Well, no, it's over a year. So if
Okay.
you've been in a stock for over 2 years or over a year, I should say.
I guess a year, then it's long term.
Yeah, that's right. So this is
Got
a
it.
long-term gain. So now we got to decide.
So A or C.
That's right.
So the math on this would be,
Well, you're going to report the dividend income in the year that you receive it. So you've already paid taxes on the dividend income. So what you haven't paid taxes on yet is the $300. Right? Are we clear? You get the dividend. If you collect dividends this year,
yeah,
and then you owe taxes this year. And if you get dividends next year, well, then you owe taxes in the year you receive them. And so we've already taken care of the consequences of that dividend. So that means now what we're left with is deciding what we're going to do with the $300. And we have decided that it is a
long-term gain.
Yeah, so we're going to have a long-term gain of 300.
Yeah. That one's hard.
Yeah. ABC, here's another good one. I like this one. The second time they've asked us to do this, a public offering price of 15, NAV of 14.25. So you remember how we're going to proceed here?
75 cents.
Right on.
So 50 divided by, divided.
So 75 cents
divided by
15.
0.75.
And we get 5%.
Divided by 15. 5%. Yeah, that's perfect.
6 days into the cooling off period, the issuer receives a deficiency letter from the SEC requesting clarification and corrections. Once the issuer submits these and assuming that they satisfy the deficiency, the cooling off period will resume. With no further deficiencies, it should become effective.
Oh, it's either B or C.
Yeah, they're either going to, we're going to extend it or
15 days.
What's that?
I think it's 15 days.
Well, well, remember, it's very testable. The cooling off period is 20. Right. So
is it really? I thought it was 30.
No, it's 20 days. So the cooling off period is 20 days.
Sorry, that's Reg S. Sorry.
So here, if it's 20 and we're 6, it says during the cooling off period, we get that letter, we satisfied. So 6 days, we got 14 days left. So
I got that wrong. I'll remember that. I remember this.
Well, that's part of the process, missing questions. A non-convertible feature for corporate bonds. Oh, excuse me, a convertible
feature.
A convertible feature for a corporate bond allows
Might be B or C. Oh, maybe D actually, to convert its debt securities to those offered by another issuer. I'm gonna go with D.
bad miss.
Which
It
one was?
allows you to convert into common stock. You can convert your bond into a fixed number of common stock. Key point, ownership rights means common stock. When you have ownership rights in the corporation, it's common stock.
Oh, so it's A.
So it's A, indeed.
Ownership. Oh, oof.
Yeah, they're being jerks here to camouflage common stock by saying
So
ownership
common stock,
rights.
if I see ownership rights,
Yeah, that's what you are, right? You're an owner of
yeah.
the corporation. So that one was
I
tough.
actually might have seen that on the exam.
Well, we do, Kaplan does debrief. So I send in debrief to Kaplan. Sometimes there's people out there saying, oh, nobody knows what's on the exam. And I got to be careful. You don't want to call BS on somebody because,
Can you take it over again? Like multiple times?
no, if I take it, I can't teach for 2 years because they assume that I would, do it. So, over the course of my career,
Well, we'll
I've
do a
taken the
debrief
test a
after I
couple
take
times.
it.
Well,
No,
yeah, I'm not allowed to ask it.
let's
So just so
us.
Allison, what I am allowed to ask is like, what do you think we could have done a better job on?
100%.
I can't say, hey, Allison, what was question 35?
No.
But yeah, we do a lot of debrief. I had some real good debrief come in that I just sent off to the guys at Kaplan, the right practice questions.
No. We'll
Said, here you go. And, Chuck, he's one of the guys who goes, oh, this is great. I'm writing questions right now. I'm going to incorporate them. So I'm glad I made your day, All right. In order for a registered rep of a member firm to receive any form of compensation, such as commissions after terminating employment, all the following statements are correct, except.
I think it's you have to enter into an agreement.
That's exactly right.
Before the termination of the employment.
That's exactly right.
It's A, right?
The agreement must be entered into before you be eligible. Now it can only be paid on your existing customers. No, you can. There's no yeah. So it's actually B, earnings, except earnings from referred business from existing payments would be eligible.
Oh, it's B.
Yeah, the grammar on this is incredible.
Oh, okay.
Key point here.
Except.
Yeah. Remember, no concessions, discounts, or allowances to people who are registered as the main point.
Got it. Earnings from, I got a Tesla. I got a question like that.
Yeah. Which of the following securities is the underlying asset used to create an ADR? I kind of like this.
Oh, is it? It's not.
So what is an ADR?
It's not a warrant.
It's not a warrant.
No, it's not. I got a question like this recently, like except.
Yeah.
Is it common or is it?
Yeah, it's the common of the foreign company, right?
Yeah, ADRs are common.
Yeah, it's like a Hyundai or Nestle or Heineken or Toyota. Data instruments put up for auction by the U.S. Treasury Department that offer intermediate maturities. Intermediate. So short would be T-bills and long would be T-bonds.
The bonds, yeah.
So intermediate would be something between T-bills
and bills. T-bonds. Oh, the notes.
Right on.
T-notes. So it's bills, bills,
notes and bonds.
Bonds, yeah.
In order for a gain to be taxed as a long-term capital gain, the position must be held for how long?
More than a year.
Boom, yeah, that's it.
But 1 year or more, what's the difference? No, it has to be more than a year.
Oh, yeah, that's right. That's exactly right. Which of these statements is true regarding a shelf offering?
Shelf.
So better to have the securities on the shelf and not need them than need them and not have them.
Ugh. Show registration allows the issuer to sell portions of it over a 5-year period, 4-year. Well, I think you have to do a supplemental prospectus, right?
Yeah, you do, because people got to be informed, right? So boom,
Is
supplemental
it
prospectus.
C?
It's C. Good
Yeah.
job. That was a tough one too.
Yeah.
All right, let's see. All right, here we what submit? You still have one unanswered question. What did we not answer? 32.
We didn't?
Maximum gain on a long call is unlimited.
Unlimited, yeah.
All right, let's submit. Well, I helped you on a couple of those, but damn,
I was gonna
that's
say
pretty.
you helped me.
Yeah, that's pretty damn good.
That's
I know.
not
What do you
bad,
think?
but I still
Yeah,
don't know.
not bad at all. So as your tutor, what I would say is what we're interested in is a session on options. I think there were
100%.
I think there was some rough sledding on that. And then we might want to do another simulated practice exam again, where I keep my mouth shut and really make you do it the hard way and get the score. But hey, I'll
Not
take
horrible.
it. Yeah, no, I will take that. I think that's a good performance.
Could we do maybe some time on, I don't think I booked any time yet.
Okay.